The new proposed global tax rate will bring challenges, but in our view, also a number of opportunities for our country. The idea of taxing companies at the global minimum tax rate has existed for quite some time. However, it has recently found significant support from the OECD and the G7 group of countries. The renewed impetus is that there should be a global minimum tax rate of 15%. In addition, the talks being held by the G7 and the OECD also propose measures to make companies pay taxes where they generate their sales and not just where they are located, the so-called Pillar 1 measures. Across the larger developed economies, there has been no significant opposition to this proposed minimum tax rate, which may leave smaller economies like Switzerland or Ireland under pressure to accept the reforms. Finance Minister Ueli Maurer said he is willing to discuss reforms and wants simple, clear and moderate solutions. Today, in light of the global debate, I would like to discuss 3 aspects of what the global minimum tax rate will mean, especially for Switzerland. As a business location, Switzerland has long been recognized for its high quality of life, ease of access to European markets, educated and multilingual workforce, as well as having an attractive tax environment. Switzerland often features high on the list of the world's most attractive business locations. Notwithstanding this, the country has high operating costs, such as wages, property rents and rates, which in the past have been balanced by lower tax rates. Now the tables are turning, and the introduction of a global minimum tax rate may weaken the overall tax benefit of operating in Switzerland compared to other higher tax countries. The opportunity now lies for Switzerland to strengthen other areas of business, so that overall we will still remain attractive and competitive. Investing in our infrastructure, ensuring it is easy to do business in our country, and continuing to invest in our digital, scientific, research and entrepreneurial capabilities will help balance out the fact that the tax rate has risen here. One of the potential upsides of an increase in Switzerland's corporate tax rate will be an increased income flow to the Swiss governments. This will give the federal government and the cantons more financing options to invest in strengthening other areas of the business and social economy, such as investing more in research and development capabilities, such as facilities, programs and R&D incentives. Further developing and strengthening our education system at all levels. Further building on our IT and cyber infrastructure system. Reducing social security costs and ensuring we put the right measures in place to contribute to climate change mitigation. Some preliminary research undertaken by Deloitte indicates that many companies would like the federal government to improve the business environment by reducing Swiss withholding taxes, especially in face of higher global corporate tax rate. The key point to consider here is what are the top priorities for both the federal government and the cantons in terms of using the extra revenue stream to strengthen the economy in fundamental ways. The implementation of a global tax rate will, no doubt, be complex for all affected countries. It will affect tax authorities and corporations worldwide. And this will be very true for Switzerland as well. It will impact our tax governance and compliance rules, our supporting tax systems, and will also require upskilling and education of staff, all of which will necessitate investments of time and money. In addition, national and international accounting standards, such as Swiss GAAP and IFRS, will need to be adjusted to ensure proper alignment with the new tax rate and related requirements. And certainly, during the early years of implementation, there will most likely be disputes between countries and with national and international tax authorities, which will need to be discussed, ironed out, and resolved. So overall, the new proposed global tax rate will bring challenges, but in our view, also a number of opportunities for our country. The challenge will be that corporations located in Switzerland will face higher tax bills. However, that will also be the new reality in other countries as well. In addition, we will need to reform our tax system, and our tax authorities and their dispute resolution systems will need to adjust to these new requirements. On the plus side, Switzerland will have both the opportunity and the additional financial resources to strengthen our strong, positive business attributes. These include our efficient infrastructure, our business-friendly and transparent regulatory environment, our very strong talent and education base, and our high emphasis on innovation, research and development. The imperative then will be to make what is good even better, and to ensure Switzerland's competitiveness as a business location of choice remains high on the global stage.